I'm going to run through this handful of bullet points here. What are employment-related securities? Why does it matter? The practicalities of reporting, common pitfalls, and areas of HMRC focus. And something there, the final bullet point, Pisces, which is a very new exchange that's been introduced. The FCA have regulated it, and it's in its nascent phases, but actually for private limited companies, it gives a nice opportunity to basically create a market for your shares. So I'll talk about a bit more about that later on. So if we move on to the first slide, what are employment-related securities? So the reason we thought we'd do this webinar is because employment-related securities is an area of the tax legislation that I think is not necessarily well known to the layperson. In simplest essence, what it is when you've got an employee and they're given shares or options in the company they work for, that's effectively an employment-related security. Also, loan notes are included in that category. And those are the areas where I think people don't necessarily consider, oh, this is an employment-related security. And when they will think about it is where they've actually done something a bit more conscious, like an approved share option scheme, like an EMI or a CSOP or a SIP or a Save As You Earn. There's normally much more formal advice in relation to those types of schemes, and so therefore the employment-related securities aspects are normally considered at that point. In terms of the reporting requirements, as there on the fourth bullet point, it shows even if there's no tax at stake, i.e. even if the employee pays full market value for their shares, it doesn't actually obviate from the reporting requirement. A reporting is still required. So, it's not something you can just look at the tax side on and say, well, we don't have to worry about it. Equally, there are a number of deeming provisions in the ERS legislation. So even where there's not direct share issues, it could potentially be caught and be reportable. It matters because it's statutory obligation. It's in the tax legislation. It's in ITPA. And again, when you have more informal share issues, not in a formal share scheme, that's where you're most likely to trip up on these things. So what that could mean is, you've given some shares to an employee, they're valuable shares in a company, and you didn't necessarily consider their tax consequences. Well, that's where, when they're, it's all unwound and that company is sold, that's when these things will come to light. And, we've dealt with one of the areas that we're very strong on at RPGCC. We've got a transactions team in our corporate finance that drives a lot of our tax due diligence work. And we see this time and time again, where you've got private limited companies coming up for sale and they haven't necessarily dealt with their share issues correctly. They haven't reported the ERS on the ERS returns, which can result in these late penalties. And even worse than that, they haven't considered the tax consequences, so that, if shares have been issued with the wrong value ascribed to them, then it can result in income tax charges, unexpected income tax charges, and likely national insurance contributions charges for the employee and the employer on a sale. So these are really important matters to consider, obviously before a sale, because during a sale process, they can be very stressful and they can hold up the whole how everything is run. So if you have issued shares to employees in the past and you're not in a sales process, it's worth thinking about it now and resolving it now before looking at it on a sale. So in terms of practicalities, if you have issued shares to an employee, it's all online filing now with HMRC. This is, I think, one of the first areas of HMRC that went online only. It's been online only for, I think, at least 10 years. And so what that means is the company itself needs a government gateway account. Nowadays, if you've got a relatively newly incorporated company, you probably set one up as part of the incorporation process. But there's plenty of companies we come across that don't have these set up. And equally, there's quite a lot we've come across where there is one, but people have lost access to it. Maybe it was set up by an individual who's no longer part of the organization. So I think our warning, our advice here is, if you realize that there's an ERS reporting requirement, the sooner you address it, the sooner you look at the practicalities of dealing with it, the better, because trying to reset government gateway credentials can be quite painful with HMRC. And equally, if they're new credentials you want to set up, you do have to wait for security codes through the post from HMRC. Things get sent out second class. So again, the earlier you can do it, the less stress there'll be. In relation to this, as you can see, 6th of July deadline. So just to be clear, ERS reporting is an annual reporting requirement following the end of the tax year. So the 25-26 tax year just finished in April, just gone. And so this reporting window that we're talking about that closes on 6th of July is for the 25-26 tax year. Another point to bear in mind is, again, if you issue a share to an employee, you need to register an ERS scheme. That might be running alongside an EMI scheme, for example. That EMI scheme has its own annual return filing and its own deadline, same deadline, but both of those schemes need to be filed. Otherwise, they attract their own penalties. We always recommend to clients, especially when they're a bit more active in issuing shares or options to employees during the year, to keep a note of the movements during the year, because it makes it much easier when you get to this time of the year and the filing window is opened. In terms of penalties, there's an automatic £100 penalty if that 6th of July deadline is not met, and then it can go up to £700 depending on lateness. Although there is also provision for HMRC to go beyond that, but that requires a bit. It's not automatic penalties above the £700, so it requires someone to HMRC to actually look in and decide that this is sort of deliberate lateness, and we'll have to go for higher penalties. Also important to bear in mind that ERS reporting is, as it says there, it's a declaration of share activity, share movements in the year. It doesn't actually itself precipitate the tax bill, tax charges. Depending on the circumstances, it might be that the individual, the employee, the recipient needs to file a tax return to say that they've received these shares at undervalue. Or if it might be a payroll matter, depending on if it's a readily convertible asset, which in shorthand effectively means if there's a ready market for the shares at the time they were acquired. So most private companies won't be readily convertible assets unless there's a sale ongoing. So I focused a lot in the preceding slides on share issues on options. But actually, the ERS reporting goes a bit further than that. It has a number of tabs on it. And technically, changes to share capital need to be reported. That's more in relation to EMI share schemes. So even if no options have been issued in the year, or there have been no changes and no surrenders, no lapses, there's still a reporting requirement on changes to share capital. Again, changes to schemes, option lapses and surrenders, they need to be reported on returns, on ERS returns. So again, you haven't issued any options in the year, you still have something to report to HMRC. Some share sales, that point alludes to the fact that if a sale, an employee sell, let's say they leave the business and have to sell the share back, if this sale of the share was above market value, then that needs to be reported, and share option exercises need to be reported. Again, whether they're EMI or unapproved share options, they will need to be reported. One other point to remember is once a ERS scheme has been registered, it needs a filing every single year. So I've obviously on this slide talked about changes that need to be reported, but technically if there have been no changes, nil returns need to be filed. And often people do miss that once a scheme has been registered, there's an expectation that every tax year an ERS return will be required until that scheme is shut. So as I've mentioned earlier, in terms of reporting pitfalls and areas of HMRC focus, the 6th of July deadline results in automatic penalties. So, the HMRC's computer systems are designed and set up to pick up schemes that have been registered that haven't got filing. So again, nil returns. If you miss that, you'll get a penalty, even if there was obviously nothing to report and no tax at stake. Valuations. So again, this is more commonly seen where you've got unapproved share options where you haven't been able to agree share values with HMRC or share option values with HMRC. As part of the filing, you're required to put a market value in there in the return. So that's, you need to have those valuations correctly prepared, and ideally you want them independently checked, because valuations is one of those areas where it's I've often heard it described as an art rather than a science. So there are a number of ways you can value a share in a company. And so it all comes down to the precise circumstances of that company, what it's doing, what its trading history is like, often what the sector it's in. So that does take a lot of thought, the valuation side. And that's the first time that valuation, when you on the ERS return, it's the first time you're telling HMRC about it. So you need to be happy that it's substantive. So other areas of pitfall, again, something I alluded to earlier, informal ad hoc transactions and a reorganization. So this is a really interesting point, that basically if you've got a private limited company and you have inserted a holding company, which is quite common, something we see a lot, that we get a call for a lot of our clients to do. Technically, when you've exchanged shares in your trading company for shares in the holding company, that's an ERS reportable transaction, even though in most cases it'll be tax neutral. And again, in most cases, we'll have recommended to clients to approach HMRC to get confirmation that they don't have any objection to it being tax neutral. So even that needs to be reported. What I haven't particularly referred to earlier on in the conversation about reportable transactions is I've talked about employees acquiring shares in companies and share options in companies being reportable. Often, a lot of the companies we deal with, do have family members involved. It might be spousal. It might sometimes be adult kids. There is a limited family exemption that applies. That means that some transactions don't need to be reported when they are the reason for the shares being issued or transferred have been for family circumstances and not anything to do with the roles that the individuals undertake in the company. So I think sometimes here people overlook the limitations potentially of that exemption. So we always recommend people to take advice as to whether that will apply. Another area of risk is poor audit trail. So often people will go ahead and make these share issues or issue these share options and won't necessarily have kept these paperwork as they've been going along. So it's very important that people do keep these in a safe place. Section 431 elections, very important. So very briefly, most shares in private companies are what are known as restricted shares. And so what that means is there basically can be an income tax charge on a sale unless a Section 431 election has been completed on acquisition, basically within 14 days of acquisition. It is an area that comes up time and time again, and mostly it comes up again on transactions. So this is a really important point that people need to be cognizant of when shares and share options are being issued. And also Section 431 elections, it is one of the questions on the ERS return at the end of the year, whether one has been entered into. So again, very important to keep those documents as you've been going along. So now I was going to move on to this Pisces. As I mentioned earlier, this relates to companies, again, private companies that they're not listed. There's no chance for them to effectively create a market for their shares historically. So that's why Pisces has been introduced. As I said, it's in very early stages. I think a couple of companies have done Pisces transactions. I mention it because in the context of an ERS webinar, because HMRC have adapted the EMI rules and CSOP rules and the share option rules to say that a Pisces transaction, they've all been grandfathered into EMI rules and CSOP rules. So it's an acknowledgement that there's been some regulatory changes, and that the EMI, CSOP, etc. legislation has kept up with that. I think in terms of from a commercial side, I think it is a really interesting opportunity for private companies of a certain size, because it's not all private companies can do it. Private companies of a certain size, it's interesting that they are able to effectively access capital markets in this way. So it is something to bear in mind for companies of a certain size and maturity. So feel free to contact us following this webinar if you want to find out more about that. And that takes us effectively through the end of the slides. So I was wondering if there were any questions.